Good morning, everyone. Welcome to the BBPA's Community Space for Financial Literacy. As some of you may know, I'm Chanel Smith, and I'm obviously delighted to be your host for the next few weeks while we take down the basics or the introduction to trading. So this week, let me share my slide with you guys. Here we go. Hopefully everyone can see. If everyone doesn't mind, I want to get some numbers in the chat. I'll start with my favorite number. I usually get started. And if everyone could just drop your number in the chat so I can make sure everyone's chat's working and that we can engage okay. My favorite number is 4, so I put that in the chat. Let me know if I can see some numbers. Caleb, thank you. Number 2, thanks, Tanya. Awesome, awesome, awesome. Okay, Charmaine, good morning. Awesome, awesome, awesome. Okay, so if you guys can see my screen, welcome to week 2. We're talking about order strategies and timing. All right, so hopefully if you guys don't have any background about this subject, this is your opportunity to gain a little bit of knowledge about that. I'll give you a little bit of background about myself before we dive into everything. I'm Chanel Smith. I'm the founder and executive director of TSK Wealth Planners, and I'm also now the outreach officer of the BBPA's Little Jamaica office. So some of my credentials consist of my honors BCom in finance, my Bloomberg Market certificates, and my advanced diploma in financial management. So that's just to let you guys know you're in trusted hands as we get into everything this week. I'm going to go over what we went through last week. So last week we introduced stock market fundamentals. So we talked a little bit about types of stocks, different types of stocks, and how trading works. So before we even move on, can someone, if you want, you can type it in the chat, but you're also welcome to come off mute. If someone wants to share maybe one of the 2 commonly used types of stocks or shares, if you remember from last week. How about preferred shares? Does anyone remember what a preferred share is? Let's see. Get into the chat. Does anyone remember what a preferred share is? Voting rights, all that kind of fun stuff. Okay, so let me dive into a little bit of, oh, I see someone said something there. Okay, Tanya missed last week's session, and that's okay. So we're going to do a little bit of a recap so that anyone who did miss last week can have a little bit of an understanding of what we did so that we can jump into this week's stuff and you're not too behind. So we talked a little bit about what the stock market is. We did an overview of the stock market, kind of talked about how it functions and its role in the economy. We talked about different types of stocks. So that's the question in reference to the question I just asked. So the differences between common and preferred stocks. So little things like preferred stocks having voting rights, but common stocks being what typically is offered to the public, which might not come with as many voting rights and influential capabilities, but also we know that those stocks are paid out in priority, right? If a company dissolves or files for bankruptcy. So sectors like health, tech, finance, we went through all of that stuff. We talked a little bit about how trading works. So understanding the buying and selling of stocks, different exchanges like the TSX, so that's Toronto Stock Exchange, the NASDAQ and other stock exchanges or other exchanges that exist, and the role of brokers. So when someone's facilitating trading on your behalf, right? The role of investors, traders, and distinguishing the difference between long-term trading and day trading. And that kind of brings us into what we're going to talk about this week. So in today's session, we're going to talk about understanding market orders, trading strategies, and the importance of timing in trading decisions. So I'll break down the session for today as usual, so you guys know what you can expect, what kind of things to pay attention to. And if you have any questions for me based on what the session breakdown is, then I'll ask that for a few minutes and then we'll jump into everything. So today we're going to talk about types of market orders. So we're just going to go over 3 main types of market orders to keep things simple. And that's just a basic market order, limit orders, and stop loss orders. Okay, so we're going to explain that kind of stuff. I know those are terms that if you guys are interested in trading, you probably commonly hear, but they can sometimes get a little complex. Okay, so we're also going to go over different trading strategies, and we're going to focus on the two most dominant trading strategies in the market. So we'll look at an overview of day trading and then buy and hold strategy. So I kind of want you guys to keep that in mind. They're opposite in many ways. So we'll also discuss the importance of timing. So how market timing can affect your trades and strategies for entry and exit. So we will also discuss what that means, right? What does it mean entering the market? What does it mean exiting the market? And a lot of the times financial or trading or investing terminology differs from the typical terms that we use many words for, right? So we're going to talk about some of those terms today. And then lastly, we're going to end on the fun stuff, which is the psychology of trading. So right now it's becoming really popular in the financial industry to also be taking into account economics, which is essentially the way people function in the economy, right? And on a macro level, so on a whole, and on a micro level as individuals. So we'll talk a bit about the psychology of trading and how managing our emotions influence our buying and selling decisions. Sounds good? Okay, so I'm going to break from this presentation to see if there are any questions. Okay, awesome. I saw here, Charmaine, that you asked a question about the videos. Stephanie tapped in and answered you there. Thanks, Tanya, for that. As well as there are handouts that I prepped for you guys with some definitions and that kind of stuff. So those are week to week. You guys will have those to also follow along during the sessions and then to keep as well for future reference. So those will go out via email early, probably today or early this week, next week, I should say. For now, are there any questions about what we're going to be getting into today before we jump into things? I'll give you guys a second to type. Also, feel free to come off mute when we're engaging. If it's quicker for you to just come off mute and add something to the conversation instead of typing, I welcome that as well. Any questions about today's session? Okay, so I'm going to jump back into my PowerPoint. And if at any time you can't see the screen or you can't hear me, please feel free to come off mute. I don't simultaneously see the chat and see my PowerPoint at the same time. Sounds good? Okay. Awesome. We went over last week. Okay, so a couple opening activities for us. If you guys remember from last week, I asked you guys to name a public company and to share why you might invest in it. So today I want to touch upon that question as our icebreaker. So would anybody mind sharing a public company that they know of and why they would want to invest in it? And I'll give you guys a couple minutes to kind of think about that. We kind of ended on that activity last week. So given that we went through last week's session and we're here today, let me get some opinions on a public company you guys know and why you might invest in it. Even if you weren't here last week, it's a nice way for you to warm up into the type of discussions that we're going to have today. And I'll give you a second to type if you're typing in the chat, and you could feel free to come off mute as well. A public company that you might invest in. So for me, I'll give you two of the big A's, Apple and Amazon. I am invested in both, so it wouldn't be a would be for me. It is a yes. I've used both of their products heavily, right? I use Amazon as a consumer, and I also have products that I sell on Amazon. And then I also use Apple products highly for consumption as well. So I'm invested in both of those companies. I know I'll pay attention to the info and stay up to date. So how about you guys? Would anybody like to tell me a public company that they would invest in or are invested in? I'm looking at the chat, listening to you guys here on mute. If you want to come off mute, feel
I had
free.
a hello, can you hear me?
Yeah.
I had a question. What is your return on investment when when you chose to invest in those two companies out of curiosity? I don't have an answer because I'm new to the class, but
Yeah.
just curious.
Yeah, no worries. I wouldn't say that there's like I wouldn't be able to answer your question with like a single denomination. I'm a buy and hold investor. So I could tell you, let's say for example, I bought an Apple share during COVID for about 221. And I think Apple shares right now are like somewhere close to 400, if not give or take a fluctuation. So that gives you like pretty prime
Cool.
numbers. Yeah. And that also
Great,
is
thanks. That's
about the
helpful.
market. Oh, for sure, no problem. That's also about the market bouncing back from us being in a pandemic. So there were a lot of people who, we'll talk about that today, used their emotions to invest and pulled out of a lot of solid companies that they should have held holdings in. And then given the time and the bounce back of the market, a lot of those companies outperformed the best that they ever have in history. So for example, in 2023, the market had an average of 16 to 20% returns, but a lot of people financially were not doing really well. So they didn't have money to put into the market. So we'll talk a little bit about that later on today as well. Hopefully that answers your
Great,
question.
thanks.
And Chanel, we have a couple comments in the chat. We have Adam Kane, who said Suncor.
Awesome.
Greg Arthur, Coca-Cola. In his opinion, they have a proven growth record and a diverse group of companies. They'll be around for a long time. And then Tanya Reid is an angel investor in VC, and she would invest in Portland Holding, Michael Leachin's company.
Okay, awesome. Thanks, Tanya, for adding that. Yeah, I know a lot of people. Michael Leachin is definitely generating a lot of buzz right now. He's a lucrative guy. We know he's a billionaire. I think he's the richest Black man in Canada. If I'm correct, I would stand. If I'm incorrect, I'll stand corrected. So definitely, I think that would be promising to head in that direction. Coca-Cola, again, it's in the confection industry, always a solid investment, right? So we know for certain that there are certain industries, healthcare, confection, anything that has to do with like consumer goods. If you take interest in any of those industries or any of those companies, those would be good public companies to invest in. And then Suncor, Adam, I'd be interested to hear a little bit more about that too. It'd be nice for you to tell everybody why Suncor, right? And then I can read that answer out loud when you give it to me for sure. Thank you guys so much for participating. Thank you. Yes. Yeah, no problem. And I'm going to get into our second poll question of this session. So my poll question is, how confident are you in your understanding of market orders? I'm going to say scale of 1 to 5 for everybody. Let me know, how confident are you in your understanding of market orders? Scale of 1 to 5, scale of 1 to 5. And don't be shy. We're going to talk about market orders today. They are a complex subject. Okay, some ones, some zeros. Good. That's good. So it means we're not wasting any time. Awesome. Okay, so we're going to dive into some of our material today. That was just a quick little poll so I could have an understanding of what my audience is like. These are some few key things I want you guys to pay attention to throughout today's session. So if you're a note taker, get your pencils, pens ready. And if you're just a mental retainer, then get your mind ready. So pay attention to these few key things throughout the session. I told you guys my favorite number is 4. So a lot of the gems I offer you guys are going to come in 4s. Number 1, different types of orders provide traders with flexibility and control. So it's important to understand that flexibility and control. Right now, it's like, what does that even mean? But once you develop an understanding after today's session, you'll get what flexibility and control has to do with trading. Number 2, trading strategies vary based on time horizon. So what is a time horizon? A time horizon is basically just your idea of how much time you want your money to be gone for, invested for, how much time you have to lock it in, or whatever your goals are based on. It's the horizon of how long your investment's going to be locked in for, or how long your money's going to be gone for. So that's time horizon simplified. And your goals, right? So timing is critical in trading. That's number 3. And poor timing can lead to losses. So we'll talk a lot, again, when we're talking about the psychology of trading and emotions. We'll definitely touch on this and highlight why timing is critical and how poor timing can lead to losses, right? And last but not least, of course, emotional discipline is key to effective trading. It's really important today that we talk about some of these subjects. It's always obviously undermined the psychology of trading, but nicely now and newly now with social media and that kind of stuff, connecting finance to the people, we come to an understanding that it's actually really important, the role that our mindset plays, right, in investing and in financial literacy. Okay. So let's keep going. I don't see anything in the chat just yet. So now we're going to talk about types of market orders. Okay, so first we're going to talk about just a regular market order. So a market order is in order to buy or sell. So if you're taking notes, I would highlight that it's in order to buy or sell a stock immediately at the current price. So for example, if I'm going to go and buy a share of Apple right now, I'm going to place the order, set it to go off immediately. That's just a straightforward market order. Does that make sense to everyone? Good. Okay. And if anyone has any comments or interjections, come off mute if you would like to interrupt me, or in my spaces or breaks when I check the chat, I'll see it at that time. Okay. So some pros to market orders are that they have obviously fast execution because they're executed immediately, right? As long as you do it during market day when the market's open, 7 a.m. to 4 p.m. if I'm correct, then the order will be executed immediately, right at that very down to the second, if I'm right. However, what you don't have is the opportunity to take advantage of different forms of stop loss orders, those kind of things, right? So the cons are that prices could change quickly. So let's say you go in to buy something and the order is triggered immediately. So based on seconds, within a second, that also means that the price can change, right? So it could lead to losses and that kind of stuff immediately in the moment. So these kind of execution, like real-time execution orders, are typically used by day traders, right? So even though we commonly just think that as everyday, traders, regular people, that we should go in and always just execute orders immediately right there on the spot, this type of order is typically used by a day trader, right? So that's type 1, just a regular market order, plain. Okay, and I will look for questions in the chat when I'm done explaining the 3 types of orders that we'll talk about today. If you want, you can come off mute. So the next type is a limit order. So a limit order is an order to buy or sell. So it could be to buy or sell. The reason this part is important is because some types of orders are only for buys and some are only for sells. So far, market order is for a buy or sell. Limit order could be for a buy or sell. But with a limit order, it's to buy or sell a stock at a specific price, right? So you might say, I might think, Apple kind of looks like it's on a little bit of a downward trajectory this week. I'm going to set a limit order to buy Apple maybe 50 cents less than what I'm seeing it at right now, right? What's going to happen is when or if Apple stock does hit that low, so does dip down to 50 cents less than whatever that price was that I saw it at, my order is going to execute. So automatically, whatever app, let's say I'm using Wealthsimple, or if I'm using TD Investing, it's going to execute that order. Now, pay less attention to what this actually is going to look like, because we do have a weekend here where I am going to use Wealthsimple on the platform for you guys and screen sharing that so that you can actually see what putting through these different types of orders looks like. But right now, you need to pay attention to what these different types of orders mean, right? Hopefully that makes sense. So some of the pros of executing a limit order is that it provides price control, right? So the example I just used to explain to you guys, it's price control. You get to essentially decide what price you're willing to pay for that stock. And if it never hits that price, then you never pay for the stock. So hopefully that makes sense. Some of the cons, as I just mentioned, are that it might not execute, right? So Apple might not dip down to that lower price that I predicted, and then the order doesn't execute. Now, again, to jump over to the pro side of things, you don't lose if it doesn't execute. There's not a fee for that, or whatever the case may be. It just doesn't execute, right? So then you just don't end up acquiring the shares. Hopefully that's straightforward. I'll take a pause right here and double check the chat to see if there are any comments. Are there any questions so far? Is everything straightforward so far? Do we understand a market order, and do we understand a limit order?
Can you hear me?
Yeah, Dwayne, I can hear you.
I just want to confirm. I think I get it, but I just want to make sure. So, just with the limit orders, that can be for buy or sell, right? So, if I say I wanted to buy a stock at, say like you give example Apple, if I wanted to buy a stock for Apple at 55, whatever, I could do that too. It doesn't have to be sell, right? Pretty much, right?
Exactly. Yes. Yeah. So you could also do the same thing. You could say, okay, I want to sell Apple if it hits a certain height. If I'm seeing, okay, Apple looks like, by the way, I would not advise to sell any Apple shares at all anytime soon in any way. Just that, giving that disclaimer. But let's say you're invested in a smaller company like Suncor. Oh, so funnily enough, somebody commented Suncor now. So you're invested in a company like Suncor and you have several shares. And then you see that there's a raise, you could put out a limit order maybe to sell 30 of those shares if the price happens to hit, if you project like a dollar raise in the next day or something like that. So you have the option to control how long the order is out for, what the price is set at, and whether it's a buy or a sell order. Does that answer your question, Dwayne?
Yes.
Okay, awesome, awesome. Charmaine, I see you have your hand up.
Good morning, Chantel. Good morning, everyone.
No
So
worries.
I just wanted to, I understand the pros and cons. I think you did it, I think you're doing a really excellent job so far. I just wanted to just clarify where the and the ors are.
For
So
sure.
from my understanding, is it that with type 1, you are both, it's in order to both buy and sell a stock at a current price?
No, buy or sell. So you wouldn't, it's not in the market, it's not possible to trigger both options at the same time. It violates policies. I don't have the legal term at the tip of my tongue, but it's not possible. You wouldn't be able to buy it and sell a share at the same time. So it's buy or sell. With the two types of orders I've given so far, the market order, the basic market order, and then the limit order, it's buy or sell. So you can set that order to buy or sell a certain share at a certain price with the limit order. With the regular market order, which was number one, you could buy or sell, but it's immediate. So it's not something you're setting. It's something that's happening right then and there.
Okay, at that current price.
At that current price right then and there. So let's say I go on my phone right now, I open up my TD app, I check out shares of Coca-Cola, and I see, okay, you know, this is a decent price. I feel like it's lower than it's been for the last couple months. I check the, you know, year to date graph. I'm like, oh yeah, this is pretty low. I want to buy right now, right this minute. I'm executing a market order. That's immediate right there on the spot. If I say, you know what, Coca-Cola looks like it's dipping a little bit, I'm going to try my luck that in the next week, it's going to be 30 cents less. So I'm going to set a limit order to buy Coca-Cola at 30 cents less than what it is right now. So if it's, this number's probably off, but if it's like $100, I'm going to set that order for $99.70. Does that make sense?
I think that's really, really helpful. And I think a follow-up question to that is, and you can choose whichever order to answer it, but essentially what I'm wondering as we're going through this discussion is, how do you know, like, what are the clues, where places you could look for information to know when it's a good time to either buy or sell?
You're hijacking my lesson, Charmaine. I can't get there. I am going to talk a little bit more about that and paying attention to trends. And also I'll mention a few times today what I mentioned before, excuse me, which is that you should only invest in companies that you take interest in, right? Because one of the things that I'll mention, there's difference between fundamental and technical analysis. So to answer your question in the short form, to not get too ahead, you use analysis and different types. Technical analysis is things we do like watching the news, reading the blogs, listening to general conversation, those different social media, those are technical analysis tools. When it comes to fundamental analysis, those are things like graph reading, paying attention to certain quantitative metrics and that kind of stuff. So we'll talk a little bit about both, and I'll also kind of tell you guys how you can meet a little bit in the middle and what are some of the key quantitative metrics that you can pay attention to just as, you know, a beginner trader, someone just diving in, but also some of the reliable, like technical analysis stuff that you could do to pay attention to some of the companies that you invest in so that you can slowly over time get better at kind of predicting those types of market fluctuations and that. And just further to that as well, depending on what your trading strategy is, not everything that happens, every fluctuation should trigger you to make a move in the market either.
I appreciate you sharing that. So when you were talking about like if you were, if you were looking at Apple and you would look at their sort of year-to-date graph, that
Right.
would be sort of an example of a fundamental analysis.
Yes.
Is that
Yeah.
correct? And
Yes.
basically, it seems as though it's something it seems as though you would find it on that same trading website, or you would have found it somewhere else.
Right. So you can um, we'll talk more about this in a little bit, but I like to use Yahoo Finance and I like to use the bank's provided information regarding stocks, and then also stock exchange sites, like as close as you could get to the source. The information is going to be the most reliable. That's what I would say. And when we dive in later on too, I'll take like some more of your probing questions so that I can get into the nitty-gritty of explaining to you kind of how you can make some of those analysis like on an everyday basis.
Thank you. I really, really appreciate Chantal, all that you've shared. I'm really basic. So I really like when you said year-to-date graph, I was thinking, okay, where can that be found?
Yeah.
And so it makes sense. Like I'm happy that the bank does make it easier for people who would like to follow certain things. And it seems as though information might be a bit more accessible than one might think.
Yeah, most definitely, most definitely. And I'm independent as well. Like I work for no bank. I'm not here to promote any specific bank to you guys, but I do try my best with our people to kind of promote like there's no need to trust an institution, but you want to get informed as well, and then just know where you can go for certain trusted information, right? So we have kind of previously been encouraged to not trust institutions, banks, and so on and so forth, but there are lots of accessible information that these types of institutions are mandated to provide us truthful material and data about, and we should take advantage of that, right? Because that's at no cost. So in that case, we definitely want to do that. I'm going to keep it going. And then, like I said, Charmaine, I will definitely answer more of your questions regarding this subject when we dive into that area. So as soon as you see it come up again, you can just jump back at me and then I'll let you know anything you want to know.
Thank you, Chanel.
Sounds good. Okay. And I see, Adam, you got to me here from earlier. So Suncor, I'm fairly new to the stock investing. I want to stay investing for long term. And I'm a company sector with a strong company sector. So I think you're saying you like the company sector and they have a strong backing. I'm not too sure. I got a little bit off course there in the end, but yes, if you are fairly new to investing, Suncor is definitely a solid. If I'm correct, you can correct me. I'm pretty sure they're in like energy or something of that sort. So anything going in that direction when it comes to like renewable energy sources, electricity, healthcare, baby boomer stuff, anything that has to do with that, solid investments. So let's jump back into the slide and let me know if you guys are not seeing my slide, by the way. So the last type of market order I'm going to introduce, it does introduce a bit of complexity, but I definitely think it's necessary for you guys to know, but this is as far as we're going to go for now. We're not going to get too much more complex than this, but jot this down. It is a stop loss order. So this is obviously a term I know that if you guys are interested in trading, you've heard this term come up before. So I'm going to explain it today. A stop loss order is placed to sell. So with the stop loss, this is not buy or sell. A stop loss order is an order placed to sell a stock when it reaches a certain price to limit loss. Okay. So hopefully that makes sense. Now I'm going to use an example to break it down. This time, a couple years ago, something came out. Company came out in China. It was called Didi, and it was presenting on the US stock exchange market. They were supposed to be something like Uber. Made a bunch of noise. I'll pause myself, Yolanda. No, so right now the slide that we're on is the topic that we're on. So we're talking about types of market orders. So we're just on that slide right now. Hopefully that answers your question. Okay, great. Perfect. Excuse me. So company came out, Didi. They were supposed to be something like Uber. If you know Uber's history, then you know it was a lucrative investment to make, right? So if you're an investor and this kind of piqued your interest, And at this time, I had much higher risk tolerance in my investing journey. But at that time, a company like that, you would think, okay, I'm going to go ahead and invest in it. Uber was really lucrative. If it's something like that in a country as populated as China, I can see it doing really, really well. Long story short, I threw about $3,000 at the company. The shares at the time were about $13. I watched them rise to 16 within a couple of days. So I was super duper excited about that. I'm like, okay, great move. Over the next few weeks, they underwent some regulatory issues, and then the stock began to plummet. So I watched it go from, it went 19, it went all the way up to 19, and then it went 19, 17, 13, 9. I can remember all the numbers as it trickled down. It was traumatic. It was my first big loss in the market, right? If I knew then what I know now, I would have put in place a stop loss order. So what that order would have done for me was said, okay, I will not be able to handle if I lose more than like half my money on this. So let's say I bought them at 12 and I'm not willing to lose more than $6. I'm going to say even $6 is a lot. If I wasn't willing to lose like $3, I would put out a stop loss order for all the shares that I have in that company at $9. Does that make sense to everybody? Can someone tell me what putting out that stop loss order for those shares at $9 would do? If someone can explain that, you can either type it in the chat or come off mute.
Yeah, I could jump in.
Go ahead.
That's Kareem here. So, yeah, thank you for the great info. It's a great session. And so that would mean that when it went down to $9, then it would automatically sell your shares for you. So you wouldn't basically like if it went anything under 9, then you would at least have $9 per share back versus like $6 or $3 per share back.
Right. Perfect. Thank you so much, Kareem. I appreciate that. Perfect. So Kareem just explained what a stop loss order is for us, right? So if I had put in the stop loss order for $9, automatically my shares would sell at $9. So that's the market understanding. Hey, listen, I cannot handle this type of fluctuation past that $9 limit. Once I get to $9, I don't want these shares anymore. At the very least, I could retain $9, $3 loss, as opposed to watching the stock plummet all the way to $3.21 and then still having to sell, right? So that's a little sad story of Chanel's investing journey there for you guys. And it also pretty much tells us the pros and the cons of what a stop loss order could do. So as we can see, it protects against large losses by setting an automatic exit point. So there comes that term exit point, right? So we'll talk more again about market entry and exit, but exit is when you're getting out of the market. So you're selling something, you're getting rid of certain shares or whatever the case may be, you're leaving the market on those securities. Okay.
Could you put a stop loss? I mean, if you were like extra averse to risk, could you put a stop loss on anytime like purchase a share? Like because I was just trying to understand, you said there's a con, but what would be the con to putting a stop loss?
Yeah.
Because it just means you get your money back.
Yeah, good question. So the cons are that it could trigger during a short-term market swing. So let's say, for example, yeah. So that obviously that answers your question, right? So let's say I put a stop loss out on, a share that is just going through a dip. This is a good time to introduce like graphical examples. So stocks make moves in two ways. They make micro moves up and down like this in the graph, and then they also make large moves like this. So we pay attention to both, right? But you don't necessarily want to move on both. If a stock is having a heavy downward trajectory long term, so that's when you see a long line going downwards over time, then you know that the stock is probably going to plummet. That's a good time for a stop loss, right? However, if a stock is just doing a small move, so a small move downward, which is over a short period of time, that is not a good time for a stop loss, right? because at that time now, the stock could just be, it could be regular market fluctuation. So that's the market on a whole and not just that company. And then very shortly after, the company could outperform itself and then do really, really well. And you've just sold all your shares, and your only option now is to buy them back at a higher price.
Got
So
it. Okay, thanks. Yep, that makes sense.
Okay, perfect. Good, good, good. I like the questions, guys. This is really good. Like, this makes me feel great. Yes, so you got a question. It will be good. Okay, good. So I'm gonna keep going here. Are we good on the market order? So those are the three. We've got the regular market order, we've got a limit order, and then we've talked about a stop loss. So everybody's clear on those few types? Awesome. Okay, let me get back to my slideshow here. Oh, Charmaine, go ahead. I saw you raised your hand. You can go ahead and come off mute to ask your question.
I'm not 100% clear on that, the last one in terms of the loss. So
Right.
so I think you mentioned about like buying something at $9. So
Right.
how does it equate? Where did we get the $3 loss though?
Okay, so we bought it at 12.
Oh, you bought it at 12.
We bought it at 12. We set a stop loss for $9. So we said, I can't tolerate more than a $3 loss on this stock. So if the stock
Oh, I
only
see.
dips down $1, it won't execute. It won't sell it for you. If it just dips down from 12 to 11, you're fine. Small dip, whatever. That's not a small dip, by the way, guys, but we're just using whole numbers to keep everything simple. So if it just does that, it's not going to sell. If the stock chugs all the way down to $9 and you were like, $9 is my stop loss limit, I don't want to lose any more money than that $3, it will sell your shares.
Okay, that's perfect. Yeah, I missed the part where it was purchased at 12. So that's why the other two numbers were arbitrary for me. So that's perfect. Thank you so much, Janelle.
Okay, awesome. No problem. Thank you. Okay. So I've got a little question for you guys so that we could take a pause and take a breath. This is my question. What order type do you like the best? So out of the three we've discussed, the immediate market execution order, so that's a regular market order, that was first. The limit order, so that was buy or sell at whatever price, or the stop loss. Ella says she likes the last two. Okay, so you like the limit orders, you like the orders, the execution orders, buy or sell at a certain price, or stop loss to be able to cut you off from losing too many profits. Okay. Does anybody else want to weigh in before we keep it moving? Okay, Caleb says stop loss. Yeah, stop loss. Yeah. Okay, we like immediate and we like limit orders. Okay. And this kind of gives me a little bit of, insight into your guys' market tolerance, right? That's something else I definitely want you guys thinking about, which we'll talk about later on in the sessions, not necessarily dive into much in today's session, but is your tolerance to risk, right? So do you have a high risk tolerance? Are you more risk averse? And that's also going to heavily influence Amani, I see your hand there. Just give me 1 second. That's also going to heavily influence the type of trading and market decisions that you make, right? You're going to use a lot of stop losses and that kind of stuff and pay more attention to the market and to your investments if you're more risk averse. If you have a higher risk tolerance, if you're more risk tolerant, you're probably going to execute day trading, more style of trading, right? You're willing to take on the risk right there in the moment. So just think about those things in reference to yourself. And also it's a key thing to make sure that even though you might take trading advice from different moguls, that you don't mimic their trading style, right? Because our personalities are all really unique. So you want to make sure you come to an understanding of your own trading style. Right? Okay. Amani, go ahead there.
Yeah, I just want to make a comment, and I'm not sure if I'm right, and I'm okay to be wrong. But back to the example that you gave about $12,
right?
And the loss, like you can tolerate more than 3. I'm thinking it probably depends on the stocks, because I've seen some stock with strong history where they can really drop, right? And when you look at the pattern and say they have dropped significantly, but they rebound so quickly as well.
Right.
So it can't just be if any stock loses,
right.
I'm selling, because it really depends. What type of stock are we talking about? We've seen some strong stock rebound so quickly. to the
Right.
point where when you sell, you regret, why did I do it so quickly? So
Right.
I'm thinking, okay, it really does depend.
It does. It always depends. And that's why today we're going over the different factors that kind of wait. There are many different factors, but as a beginner, a few of the main factors that you have to pay attention to when making certain trading or investing decisions. And the example that you just gave was an example of how using stop losses can be negative in some situations. And that's one of those situations, right? Is when you have a stock that's just going through a temporary fluctuation, you're now making a long-term permanent decision based on what could be a temporary market fluctuation. So, and then that also ties into the emotional regulation of trading. And at the end, we'll talk all about having a plan and knowing what kind of trader you are, knowing what kind of risk you can accept, and then how that all ties in to the type of plan that you create as a trader so that you can make moves based on that and the plan that you have, as opposed to making moves based on impulse and quick emotional market fluctuations. So does that make sense, Amani?
It does. Thank you.
Good. Awesome. So Dwayne said, thank you for this presentation. I'm glad to see this type of education being taught from our community. I would try to get the word out. Thank you, Dwayne. We appreciate that. Yeah, definitely. It is really important. Something I'm really passionate about is Black ownership, period. I'll just end the sentence there. It's definitely, we're at risk of almost becoming extinct in ownership in Canada. The percentages are so small. So with that being said, it's a task for me to make sure that in all ways that I can financially, that I could spread the word of how we can own different things. And to be able to execute a simple market order like this immediately represents ownership. And it's one way that we can gain some market share as people. And that's just for anybody, right? Not just us, but anybody marginalized, anybody with less. It's a great way to climb the economical ladder and empower yourself. So definitely. Okay, so now we're going to talk a little bit about trading strategies. So you guys are really locked in, and I appreciate it. And I'm appreciating all the participation and all that kind of stuff. Okay, just give me a second. Let me get into this here. So trading strategies, day trading versus buy and hold. Does anybody know anything about the difference between day trading and buying and holding?
I used to be honest. Sorry, I didn't mean to talk. I have to raise my hand.
Oh, go ahead. Go ahead. Go ahead.
Like I think, yeah, I think is holding kind of like you're kind of, I just saying, it's like predicting what it may be, and then like you set up price, how much you want this to be, and then it's kind of like the opposite of like stock loss, I guess, to some extent. Is that fair to say or no? I vaguely remember.
I'm glad that you asked that question. So we just wrapped up different types of market orders. So if you're taking notes or anything, take note that what we just discussed prior to this was market orders. Now we're going to talk about strategies. So I'm glad that you said that, Dwayne, because even when I was creating this lesson plan for you guys, I also had a feeling that the two subjects might be a little bit confusing. So I'm glad that you brought that up. So the market orders that we talked about in terms of the regular order, the limit order, and the stop loss order, those are types of market orders. That's a subject on its own that we just kind of wrapped up. Now, when we're talking about trading strategies and discussing day trading versus buy and holds, those are just two major strategies that fall under trading strategies now. So we're done with market orders. Now we're talking about trading strategies. So a market order has to do with how you execute the buy or sell. So the actual action of buying or selling a single share. A trading strategy has to do with your overall plan as to how you're going to conduct yourself in the market. Does that make sense? Is that difference clear to you guys? Let me know either in the chat or verbally. You can make a comment. Are those two things clear? The difference between an order and a market order and a trading strategy, is that clear?
Yes.
Yeah. Okay. So we're straightforward on that. So when we're discussing trading strategies, we're discussing two major trading strategies. So when we talked about market orders, we just discussed three simple, entry level types of market orders. Now we're talking about trading strategies. We're going to touch on two major, like most commonly used, most known trading strategies. And those two are day trading on one hand and buy and hold on the other hand. And I hope that is clear to you guys so far. Adam, Dwayne, hopefully that clears up. Like, that's straightforward.
Yeah, I think so. Sorry.
Okay. No. Don't apologize. I'm really glad you asked, because I thought that myself, and I knew there would be a moment where I might have to clarify that. So I'm really glad you brought that up in transition. So as it speaks to day trading, day traders buy and sell within the same day. So they try to make profit from short-term investments. Is that clear to everybody? So if you're a day trader while the market is open, so 7 to 4 p.m., 7 to 3 typically, you're online. Oftentimes day traders have multiple platforms that they use, graphs that they read, and programs and stuff like that they engage with, to keep their stats and to watch graphs and to look at trends and to do different types of analysis. And they, excuse me, guys, they buy and hold in the same day so that they can make tons of tiny profits. So they might buy and hold, or sorry, they might buy and sell shares of large volumes, but always in the same day. So their profits are made there. So it's kind of like a job. And whatever profits they make in that day is what they have day to day. Does that make sense to everybody? Any questions
You're
about
trying to master, or you a new kind of?
Can you ask that question again for me, Cream? Cream, did you want to repeat your question?
Sorry, I don't have a question. I accidentally unmuted. Sorry about that.
Oh, okay. Yeah, no worries. Okay, so does anyone have any questions about the day?
Chanel, yes, the question.
Is that Tanya?
Yes.
Okay, go ahead.
So I wanted to know when you're day trading somebody's phone.
Go ahead.
Yeah, I wanted to know, as a day trader, is there certain regulations you should know before getting into it, like in terms of taxes, with day trading versus like the buy and hold?
Yeah, the government, the nice and not so nice thing about that is that the government regulates everything that has to do with the markets. So the limits that exist change year to year. I'm not going to throw out a random number, but those kind of things are publicly available. And then it's based on your profits, right? So whether your gains are capital, if they're dividends, like so on and so forth. So you're not taxed on dividends. Dividends are considered like they're non-taxable income. But you are taxed, or dividends are taxed as like income, but not as capital gains. So when you have capital gains, let's say on a stock now that you cash out on, so let's say I'm talking about Apple that I bought around like 220 and then it raced like 400 and I go ahead and I sell, let's say I sold 100 of those shares. Those are considered capital gains. So those aren't like dividends or income I'm making over time from the investment. Those are taxable, right? Dividends are not, capital gains are, and capital gains are, equitable gains are taxed as capital gains. So you're paying like 50% on your investment. So how much you made. So I'm paying taxes on, what is that? 220, 400, 180, 60, 90, 90. I'm paying taxes on $90. And then a lot of people think the tax is the whole 50% of what you made. It's not. You pay taxes on 50%. So half of that is exempt. And then the other half I do pay taxes on. So does that answer your question?
Yes. The way to avoid it, because I hear about, this person that invested in the TFSA, and they were able to make like, in terms of gains, it's way more than the limit, like they made $1 million, or I don't know, not million, but like a lot more money in the 100,000s. But I want to know if it's only TFSA that you could avoid being taxed on, or is it, well, I guess RSP as well, but how to avoid the capital gains tax when you're investing?
Yeah, when it comes to first, tax avoidance is more of a financial planning strategy. So I would never, let's say, like, I would never trade with the idea in mind that I'm also trying, like, to avoid taxes at that time. Like, I don't think tax avoidance is a amazing financial strategy. I use it, but it shouldn't be considered when trading at the time. So when you're thinking about the decisions you're going to make trading and investment wise, you shouldn't consider tax avoidance. Tax avoidance comes into play when you're considering how to structure your money. So let's say now you want to use tax shields like TFSAs or RRSPs. Those kinds of things lower your income overall, but they're not going to necessarily exempt you from capital gains. So dividends that are treated just like regular income. So let's say if you're not making a lot of money and then you make dividend income, you're not taxed on that income because it's just income in general. So the government's not going to tax you on that because you still own the stocks. But capital gains that are considered equitable, that are triggered in the buy or sell of a stock, you're going to get taxed on whether or not your income is low. So even if my income is $30,000 and I'm like at the poverty line or something, and I'm benefiting from capital gains, the sale of capital gains stock, I'm still going to pay capital gains taxes. And if I'm shielding all my income. Does that make sense?
Yes, it does.
Okay.
Yeah.
So the only, like, your best bet when it comes to that, at this level, no one's making enough money to really, I would say, risk like trying to avoid anything in that sense. But when you do get to that level, and because I wish that upon everybody, that you have to heavily use tax avoidance strategies now, the strategies are more going to be focused on lowering your personal income than anything else. Because then when you get into, that's the only way that you can use like vehicles like RRSPs and TFSAs to protect the money at the time. And then RRSPs are still, these things are also triggered at the time when you withdraw the money too. So it's like 6 of one, half a dozen of the other, but all of those things should be considered because you could kind of avoid Uncle Sam today and then end up paying him more later on just from some of those strategies too, if that makes sense.
Yeah, that makes sense. But in terms of also day traders, is this something that they set like every week of what they do? Or are these people that it's more of a side hustle? Like, how do most day traders operate?
A little bit of both. Some people day trade as their job. Some people day trade, like I've gone to university with some pretty intense traders that consider it a side hustle, but it's vigorous, right? Because it does require a plan, but then you still do have the odd person that feels like I just know what I'm doing when I jump on my computer in the morning, like a video game. And then you have some people that strategize, and day trading all occurs in the same day. Well, that's the key thing, is it's never a strategy to say, I'm going to buy this week, and then next week I know it's going to be such and such, then I'm going to sell it, and then a few weeks later I know it's going to dip again, I'm going to buy a couple more. That is in the middle of buy, hold, long-term investing and day trading, but it's not day trading. So a day trader has a very, very, very deep and thorough understanding of the market, and then does enter each day typically with a plan. And if it's not their personal plan, then if they work for a company that they day trade for, then there's a plan that they're definitely resorting to every single day when it comes to the shares that they choose to trade. But then it also relies on a lot of analysis and active watching of graphs and metrics and so on and so forth. Yeah.
Okay.
Does that make sense?
Yeah.
Question.
Ella.
I hear that there's a lot of behind this, and then there's also an element of like, it's not gambling, but a gamble in day trading, correct?
Yeah, definitely. I would almost call it gambling. Yeah, for
My
sure.
bad. I'll try again.
Yeah, definitely. I totally know. I'll read some of these comments while Ella just sorts out she might be having just a little bit of a technical issue. I'm totally new to trading. What do you trade in stocks, something else? And to confirm, I'd have to pay taxes on trading. So you don't pay taxes on trading. I think the benefits to trading far outweigh the potential repercussions or tax ramifications. I think it's good to understand that it takes money to make money. So if majority of even day traders and people who do this as like a main hobby, their focus really isn't, you pay taxes on all the money you make. If you go to work and you work for someone, you pay tax on that money. If you make money in this country, you pay tax on that money. So tax avoidance as a strategy is a good strategy to employ, but in financial planning, I would never overlap tax planning with trading or investing like methods in on this topic. When it comes to stocks, shares and that kind of stuff, I wouldn't overlap the two subjects. Go ahead, Ella.
Okay. The question I had was around passive investment.
Right.
So would you see like the way you trade or the way you invest, like where you hold and you have like long-term vision, do you consider that to be passive investing versus day trading, which is like, you know, it's a bit quick and dirty in a way, but I mean that jokingly, you know.
Yeah, buy and hold can be passive. It just depends on what your strategy is. So kind of like I discussed earlier, we'll be 11. I'll just be mindful of everybody's time. But similar to what I mentioned earlier is that there's still a spectrum to that, right? So you can have a buy and hold strategy. Now we get into what is your management. So let's say I'm a financial consultant. So if I had a client and I was going to get in depth about this subject with them personally, and we built an investment plan, one of those main questions would be about your risk tolerance and then your management ratio. So that's like, how frequently do you want to manage the investments that you have? That goes into your buy and hold strategy because it essentially determines how frequently you revisit or how frequently you touch these investments, right?
Right.
So if I'm an investor and I'm saying, okay, I'm an investor, buy and hold, but I want to manage my investments yearly. So every single year, I want to take a look at this stuff and make some plays based on acquired knowledge, fundamental knowledge, and some technical knowledge in combination. I'm going to let, I don't know, like the person who's dealing with my finance or whoever my consultant is in that area, I'm going to let them make some recommendations and I'm going to see what I should switch around, swap around. What do I need to sell? What do I need to buy? Whatever on a yearly basis. That would be my plan maybe. Right? Somebody else is going to say, you know, I'm a little bit more active in things. I want to do like a quarterly, right? And as you can see, it can go from there. It could be semi-annually, quarterly, monthly, bi-weekly, all the way down to weekly. And then you have a day trader, right?
Okay, got it. Yeah.
So you can kind of choose what that relationship looks like. Majority of people, the issue that we have is they get their foot in the door with investing, probably purchase up some mutual funds or ETFs through a broker that's through the bank. Then they set it, forget it, never look at it again, right? Or
Right.
have people buy a couple stocks at a time that they thought things were good, bought it, put it away, set it, forget it, never looked at it again. So we want to get out of that habit and kind of be at a happy medium in terms of what each of our individual tolerance is, but to have us actively engaging in ownership in the market. Does that answer your question?
Yes, thank you.
Perfect. Awesome. Okay, so let me move. We only got to day trading so far. So let me quickly do buy and hold since we do understand buy and hold for sure. Buy and hold investors purchase stocks with the intention of holding them for long term, believing in the company's growth over time, right? So that's equitable growth. Okay, so there's also other things that come into that when it comes to buy and hold, dividends as well. So a lot of traders and investors like myself buy into companies like I noticed gas companies, tobacco companies frequently give out high dividends, right? If I buy a stock for $9 and it's giving me 30 cents a month, give me that, right? So that's not about equitable growth. I'm not thinking, as a matter of fact, Canada's trying to become smoke-free. So soon enough, maybe those stocks won't be high worth equitably, but I spent $10 on something that's going to give me 30 cents a month for probably the next 5 or 10 years. I'm good, right? So it's something like things like that. So those are long-term investing strategies as well, not only just considering equity and appreciation in the stock, but also taking into account dividends and the other things that make a stock valuable, right? Does that make sense to everyone? We know dividends. Do we get that? And feel free, if you're not there, if you don't understand something, now's the time to say something so that I can clarify it, because more likely than not, if you have a question, someone else has it too.
How do you find out what stock has good dividends?
Good question, Ella. Me personally, I am a firm supporter of the internet and AI. One of the really good skills I acquired from school, I know not everybody is always pro-education, I'm pro-education, is the ability to research and to suss things out, right? So I'm here to kind of pass that on to you guys. Use the internet, it's a useful tool. Just be careful how you research. There's just basic things you can look out for. Use credible websites, stay as close to government regulated websites as you can, unless you know somebody who is accredited researcher in a certain field, then maybe they're providing information that you rely on that is actual academic theoretical information. I would stick as close to the government information as possible. And that could look like Yahoo. Yahoo is your friend when it comes to investing. It's been around for a long time, long before majority of the banks, like TD getting their direct investing platform, that kind of stuff. Yahoo was always highly relied upon, and it's free. There are also other things like Bloomberg's and stuff that's a little bit more advanced, but you have to pay for those things. So I would say Yahoo is your friend, right? It's very user friendly. You use Yahoo Finance, you type in a stock or a ticker symbol, and you get kind of like a display of some of the basic KPIs and quantifiable metrics that an everyday investor or trader can use to kind of evaluate a stock or evaluate a stock, right? On Yahoo Finance, you're able to see every stock's dividend yield and also their dividend in itself. So you'll see the amount, and then you'll see the amount of dividend it hands out in relation to the price of the stock. That's what a yield is. So if the stock costs $1, and yeah, if the stock costs $1 and I'm getting a dividend of 50 cents, it has a 50% dividend yield, and so on and so forth, right? Dividend, not sure on that one. So what is a dividend? A dividend is a small amount of money. So it's a percentage of the stock in valuation that a company pays you. It's a portion of their profits. That's the straightforward answer. A dividend is a portion of a company's profits year to year, month to month, quarterly, semi-annually, whatever the case may be, that they pay out to people who hold their shares. It's kind of like an additional thank you. So when a company performs well, or if they typically perform well, they're in a position to give the people who hold their common shares. That's what we talked about last week, common shareholders. So we typically buy and sell common shares. They give you an extra incentive from their profits. Does that answer your question, Sarah? You can let me know in the chat. Okay, got it. So that is not your only profit though. That is the company's profits. Dividends have nothing to do with your profit. Dividends are not your profit from the stock. Dividends are a portion of the company's profit that they pay out to the stockholders. Your profits are both a combination of those dividends and capital gains over time. So it's a combination of, I'll give you guys an example if you're ready so I could slow things down. If I buy a stock and it's $10 and it gives me a 10% dividend yearly, right? That means it gives me $1 every year in dividends. Let's say that stock after 10 years raises to $100, right? My profit is the $1 of dividends I got every year. So $10 now, plus the $90 that the stock appreciated in price. So my profit is $100 from that stock, dividends and capital gains. Does that make sense, Sarah? Does that answer your question? Okay, awesome. I'm happy to hear that. Amani, you can go ahead, and then Ruth, I'll answer your question next.
And I just want to comment on you mentioned something around being careful about how you research. And I'm glad you did that, because what is happening in today's context is literally every single person can post anything on YouTube and create a YouTube channel or a presentation or links, slides, and then YouTube links it to Google. So the default for people when they search on Google and pull stuff and believe that it's reliable, not realizing that, no, there's all kinds of things on Google. Like you can get, anybody can post anything there.
Yeah.
It doesn't, so it's, I was happy when you mentioned that, because people might think, oh yeah, I got that YouTube channel, or I search on Google and I find out. That doesn't make it reliable.
Right.
Yeah, it could be very misleading information that you're getting.
Right.
Yeah, thank you for mentioning that.
Yeah, no problem. I definitely agree. And that's why I stressed it as well. And I also gave out a specific resource. So if anybody didn't hear, Yahoo Finance is that particular resource. If you ever need resources, you could always connect with the BBPA. I always plug myself at the end as well. Connect with me, reach out and say, hey, like, is this a credible resource, right? Network, and take accountability for your money. It's your money. Don't take 2 seconds and just, like Amani said, go on YouTube or something and listen to just anyone. It's your money. Take a bit of time, research, look into the stocks that you want to get into, and make decisions based on that information. And for the things that you don't know, consult with professionals in that field so you can gain more information from people that you trust. And then in combination, you can make good decisions for your money, right? I saw a question up here. Any tips for navigating transferring Canadian to USD? No, you cannot avoid currency exchange. You can't avoid currency exchange. So the only, I don't have a tip for avoiding currency exchange, but I do have a tip for, I guess, being able to save as much money as you can as possible if you're investing on US markets, which is buying USD. So you can also, the US dollar is a commodity, right? Like gold, like silver, like any other currency. So you also can invest in that the same way you invest in a stock, right? Buy low, sell high, which hopefully we do get to today in our last little segment, when we talk about entry and exit and that kind of stuff. I want to continue so that we do at least get through the rest of this material and then have a couple minutes at the end for questions. Still put your questions in the chat though. Still interrupt me if you want to, but I'm going to zip through this stuff unless you guys pause me. Okay. So we're going to talk a little bit about the importance of timing in the market. So market timing is crucial when trading. So that's what we just talked about. Entering or exiting at the right time can mean the difference between profit and loss. It's crucial to understand the concept of buying low and selling high. Again, this is what I just mentioned, right? Buying low and selling high means you're looking out for the stocks that you are interested in to be undervalued. Okay, so that's what entry and exit to the market has to do with. So if you're taking any notes or anything like that, this is really a key component in understanding trading and how to trade. So I want to stress the importance of identifying key entry points. So what are key entry points? When a stock is undervalued. What does undervalued mean? Undervalued means this. If Apple stock right now currently is typically worth, so the intrinsic value, it's typically worth $400. And tomorrow I open up and the market's saying, oh my gosh, Apple stock is $370. It's undervalued. It's a good time to buy, good time to enter the Apple market. Right? Straightforward. What's a good exit point before a stock declines? If a stock that I have is on a heavy decline, again, not an Apple stock, do not use an industry leader for these examples. So let's say I have a stock like the DD stock, which is the stock I mentioned to you guys. Even Suncor is a pretty strong stock too. I wouldn't sell any Suncor either. We'll use something like DD, an emerging stock or something like that. It looks like it's plummeting on a downward trajectory. There's long term, so there's time in between that. I'm not talking about a day, a week, or a month. I'm talking about anything from 3 months to a year worth of downward trajectory. It's a good time to get out, right? Exit time. So some common indicators traders use for timing are moving averages, right? And resistance levels. So moving averages help you to see help you to read a chart and that kind of stuff. I'm not going to get too deep into the actual fundamental analysis of things, resistance levels as well. These are calculations. So fundamental analysis believes you don't use the past, you don't use trends and all that stuff. You use calculations and forward moving mathematics to predict what a stock is going to do. Now, the people who use these kind of fundamental metrics don't always have to be the most intelligent of mathematicians. I can calculate some of these metrics, but I studied finance for the last 8 years. So every single person has not done that, but the metrics are provided for you. So when you're looking at things like year to date and that kind of stuff, these are things that now you use tools like Google, Yahoo Finance to essentially clarify what these metrics mean. Okay, let's say we're looking at the moving average of a stock like Amazon. What does it mean if this is 14.1? You can type that in and see a strong dividend yield. What does this mean? Like a strong return on income, like what does this mean? You can look those things up so that you can understand what those KPIs represent in reference to the stock. Does that make sense? Okay. So let's move on to the psychology of trading. This is our last little segment before we get into the takeaways. And then I give you guys a chance to ask all your questions, your burning questions and everything like that. So we'll talk a little bit about managing emotions. I want to highlight how fear and greed, these are two main things that you talk about in finance. So we weren't able to graduate without studying the psychology of trading. And the two major things that you discuss, two major emotions you discuss in the psychology of trading are fear and greed. So they're two powerful emotions that influence trading decisions. Fear causes traders to sell prematurely, like we discussed, potentially missing out on gains. So this is what Amani mentioned earlier, right? And then greed can push traders to hold on too long. So that's what happened to me. Greed pushed me to hold on too long to the DD stock, and it resulted in losses, right? When the market had turned. So given, like Amani talked about, fear, when people sell things and it's just a temporary little market fluctuation, out of fear, you'll lose in that way. So now the stock had dipped for a little, rose back in price, but you sold it low, which is bad. Sell low, buy high is the opposite of what we want. We want to buy low, sell high, right? And then greed, of course, forces us to hold on too long, even when something is dipping. So again, we're not following our main rule of thumb, which is buy low and sell high. We're actually allowing the stock to plummet, and we're going to have to sell low anyways, right? Okay. So that makes sense to everybody? Good. Great. And what is the solution to this? So the solution to these type of market emotions and influences is, of course, emotional discipline when it comes to finance. So we have to stress the importance of developing this emotional discipline before getting into trading. And that's what we're here to talk about today. The one advantage that you guys will have over several other people who are entering the market or entering the market on their own is that you were able to develop and to have a session like this where you're able to gain the knowledge and the soft skills around what goes into the psychology of trading. And that's what's probably most important. Majority of people will never understand a lot of the fundamentals and the deeper analysis and quantitative metrics that come along with trading and investing. But what you can do is understand the psychology of it so you know how to treat this activity on your own as a person, right? So I encourage you guys when you're trading to use things like stop loss orders, limit orders to set up target prices. So when you develop trading plans and that kind of stuff and you're looking at your stocks, use these kind of tools, right? It seems a little bit difficult at first, but use them because you'll have the opportunity to see how you can benefit from the market from using these tools, right? And it typically cuts emotional decisions and impulsive decisions from being made. So let's say, for example, I know that I see Apple doing well and I take a second to actually go look at the graph and think about where I think the company is headed and then trigger a limit or a stop loss or something like that. I'm probably more likely to make money than if I just go see that Apple's doing well and make a decision right there in the moment just based on that. Does that make sense? Okay. So before I give any key takeaways, does anyone have any question on today's material before I give the 4 key takeaways for today's session? Any questions right now before we duck out? The video to week 1 is available. So I know I saw that question. This week's video will be available. Your handouts will be available. So that'll include definitions from last week, definitions from this week. I saw you guys were really intrigued in this week's session as well. So definitely you'll be taking note of those. Is there any other resources or anything like that that I can share with you guys? Okay, at the end, I'll definitely put my plug slide up so that you guys could see all of that contact information, and then we'll put in our announcements and stuff like that for next week and all the other things that are coming up and the other opportunities you'll have to engage. Ruth, I see your hand is raised. Do you want to go ahead and come off mute?
Yes, hi. Thank you so much for this. This is really inspiring, especially to see a Black woman trader, and we're just so grateful for you teaching us these principles. I have two questions. One question is like, do you offer one-on-one coaching or training in this area? And my second question is, like I'm because I've heard of so many risks involved with trading, I'm very reluctant to start. So I'm trying to learn as much as I can before jumping in. But like, I also know like getting into it earlier is probably better as well. So do you have any recommendations for like, okay, how does one know when they're ready to get into actually trying testing the waters, and like how do you get started in a way that's safe?
Yeah, no, I hear that. How do you get started in a way that's safe? That was a really good question. Number one, I'm going to tell you, like, you're never ready, like, for anything. I would say this on every subject. If it's starting a business, if it's getting into trading, don't wait to be ready. There's no point. Because you'll never really be ready. It's like parenting or just any big leap in life. My overall advice is you're ready when the universe touched you and brought this like urge to get involved. That is you being ready. That's the most it's gonna get. So once you have that feeling, which you do, and you're in this room, it means you're ready. Now, to answer the second part of your question, how do you do so safely? Start off small, right? Just because you take a step doesn't mean it has to be a big step. Start off small. You could always send me an email after this. I can send you a list of I like to go two ways. You could go small price, small reward, get a little bit of dividends and stuff like that. See how that feels. Get your feet wet with just maybe 10 shares or something like that, and see how that feels for you. Or you go ahead and buy something, maybe like 1 or 2 or 3 larger pieces. So, but of more reputable company. So of like an Amazon or an Apple or something like that, and see how that does and just watch it. That's the way I would say to get started in a safe way, because as you see that happen with your own two eyes, like I can remember buying my first set of shares, then I can remember creating my first little package portfolio. Now I build portfolios, different types of portfolios. Now I can tell you how you can get back 6% returns just in like completely passively after spending only $3,000 like on a yearly basis, guaranteed, no loss. So it's just something you start with and then you build from there. And then your last question to answer it, yes, I do one-on-one consults 100%. When I put my plug page at the end and that kind of stuff, and I'll drop my email in the chat too, because it might make it easier for everybody to copy and paste. You could definitely reach out to me and we could figure out kind of what you need and where you are in your journey, and we can go from there. And everyone's first consult's always free with me. So
awesome. Thank you so much.
No worries. Would you advise or do you invest in other things other than stocks, and how do you get started on the platform? What are other things other than stocks? What would be, can you elaborate a little bit more on that question? What are other things other than stocks?
Forex, commodities.
Yeah, gold. Yeah. And yes, you do that on the same platform. So commodities are offered on most typical. I recommend for you guys, if you don't trade with TD, TD is probably like the most user-friendly trading platform. I think RBC has one as well now. But if it's not TD, go with Wealthsimple. Like if you don't want to go through the bank, Wealthsimple also has like far cheaper fees than the bank too. I do both. Like I don't have a preference. Wealthsimple's cool. I'm gonna end up showing you guys a trade on Wealthsimple. So yeah, you can use Wealthsimple, but TD also has a very, very user-friendly direct investing trading platform as well. And if you guys are looking to develop your own portfolios or build that kind of stuff, asset allocation, which just basically is a fancy word for where your stocks are, what industries you're spreading them across, and what companies, that's asset allocation. We can definitely get into that one-to-one. I do offer consults with that stuff. Okay. So as you guys are either typing your questions, thinking of your questions, I'll still take a few more, but I'm also going to give the key takeaways for everyone else who has been here. And I want to say thank you. This was amazing today. This was so fun for me. This is what I take pleasure in doing, like knowing that I touched the room, like you guys are all interested in trading, and hopefully I hope you guys do get into this. And by the end of the 6 sessions, like I intend to have you guys prepped to feel like you're confident enough to enter the market and to hit the trigger button on, even if it's that first trade for you, or to re-enter, to give it another try after a loss. Like hopefully, not hopefully, everyone here will get that done. But let me give you guys your key takeaways before we have to wrap up. So number 1, everything comes in 4s, right? Number 1, limit order. So market order, limit order, and stop loss orders give traders control over how they buy and sell stocks. Okay, so that's a key thing. So it gives you control over how you buy and sell the stocks. So day trading, number 2, day trading and buy and hold investing are different strategies that can give unique risks and rewards, right? So just emphasizing the difference in the two. And then timing. Timing, number 3, is critical for maximizing profit. It's important to know when to enter and to exit trades, right? So that's what we talked about. When to enter the market on some of these companies and industries, when to get out of the market on some of these companies and industries is important to consider, right? And last but not least are managing emotions in trading. So managing emotions in trading is crucial for success, and sticking to a plan like we discussed is helpful to curb or to control making impulsive decisions, right? So we want to keep those things in mind. Those are the 4 key points, takeaways from today. I feel like today was like a really big hurdle for you guys, and it helped me to understand that this is a really key part of what we don't understand, is that trigger moment, that actual action of making a trade is definitely what we want some support on when it comes to getting into trading and getting into the market. This is part 2 of 6 sessions. Yeah, so you're still pretty early on in the process. Yeah, and we're definitely going to get into more fun things. So Sarah's asking, what asset class do you think will grow the most or is beneficial to earn the most? Commodities. It depends on your horizon. So we're going basically right back to the beginning of the presentation when I said it depends on the horizon, because if my strategy is like on a month-to-month or on a yearly basis to buy and hold and to retain certain profits and so on and so forth, then that answer is going to look a little bit different than someone who plans to buy and hold a stock for at least 10 years or something, and what that's going to be, what's going to be more beneficial there. The thing is that because, and I'll leave everybody with this before the announcements, my job now is to get our people, or to get you guys or us out of the mentality of looking at stocks and trading or ownership as just passive income, right? To be making passive income from stocks, you have to have enough interest to get into it, to do it. Like people who make passive income off of things have hit a level of expertise. So don't go into trading just looking for kind of like a quick climb up or a quick opportunity to get more revenue or more profit, whether it's personal or for business. You got to go into trading with your priority being ownership, and then profits next. And your profits will become prioritized as you practice. Practice is what's going to make you a good player to make good money in the market, right? Not passive. You have to work hard for everything. It's a lie to work smart and not work hard. It's both. You want to work smart and hard, right? Nothing comes for free.